Hello, everyone. How are you? And welcome to the Credit Laboratories Clear to Close Credit Course. My name is Jennifer Campbell. I am the CEO and founder of the Credit Laboratory. We've been open since 2019 and we've helped over 400 people one on one to increase their credit scores. This year, our goal, me and the Credit Laboratory, our goal is to help 100 people become credit ready in order to purchase a home. We want to help 100 people become clear to close who have had credit challenges or face having low credit scores or they don't understand the credit process. We want to assist those people. And in order to help us get to our goal, we decided to create this course, this Clear to Close credit course. This is a completely free course where we will be discussing everything about your credit and how to get your credit home loan approval ready. With this course, we're going to be talking about what scores are needed, where to start, what scores lenders use. We're going to talk about any type of derogatory item on your report that could stop you, as well as how to fix it. So this course today is going to take us about 2 hours, but we will be touching bases on every type of negative account there is, any type of account that could stop you from getting your mortgage because of your credit. We're going to be discussing that. So without further ado, you guys, I am going to get started. We're going to be starting at where to begin. Where to begin. You guys, the first step in the process when you're getting ready to purchase a home, if you want to get approved for a home loan, no matter what type of home loan you're trying to get approved for, whether it's conventional, FHA, USDA, whatever type of loan you're trying to get approved for, the first step is going to be knowing where you stand. You're going to need to know your credit scores. You're going to need to know your debt to income. You're going to need to know how much debt you got going out, how much income you got going out. Do you need to pay some debt off? We're going to be discussing all of that, but that is where we begin. We begin by knowing what our scores are and where we stand. Now, most people would like to reach out to a lender first, but if you can stay with me to the end of this course, you will be able to get your credit scores ready so that when you do get ready to contact a home loan mortgage officer or a lender, you'll be able to get approved. So before you contact a lender, I suggest, and you guys, before I even get started, I am not an attorney. This is not law advice. This is not financial advice. I am basically going to be going through with you the things that have hindered me and my clients during the process, things that I have learned over the last 5 years. So we're going to be going through all of that step by step. But this is not, I'm not an attorney. I'm not a lawyer. This is not financial advice. I'm just telling you about different experiences. Now, the first step, you guys, is knowing your scores. Now, you know you have different scores, but we're going to need to know our mortgage scores because that's what mortgage lenders will be using. We won't be able to just use any scores that we find on the internet, even the scores that you're seeing with your bank that says that they're your FICO 8 scores. We're not going to be able to use those neither because those are not the scores that lenders are using. So the first thing is getting your credit scores, knowing what credit scores to use. Then you're going to be needing to get a understanding of how much debt do I actually have? How is that going to affect me? Because you guys, please understand that your credit score does play a factor, a big factor, because your credit score determines if you're actually able to get approved. But your debt to income ratio how much money you make and how much money you have going out. Your debt to income is going to determine how much of a home you can get approved for, because your debt to income ratio is actually going to be able to give a clearer view or a better understanding of how much home you can actually afford. Okay, so your debt to income ratio is important as well, you guys. Now, like I stated earlier, there are different multiple credit monitoring sites. Your Credit Karma with your credit cards, with Capital One, Discover, they give you a free credit score. Most of those are normally your TransUnion scores. Um, but those are not going to be the scores that we're going to be needing, you guys. We're going to be needing your mortgage scores. There are a couple of sites where you can actually pull those scores from. Before I even get into that, I want to make this clear as well. Your cons- and I'm saying credit reports. They're actually called your consumer reports. When you're getting ready to get approved for a home, when you're going through that process, they will be looking at more than just your consumer reports, you guys. They're going to be looking at your public records, your LexisNexis reports. Like, they're going to be looking at a lot of different reports, but we're going to be discussing those different reports depending on the item that it is later on in the course. So just stay with me, but know that lenders will be looking at more than just your consumer reports. And that's what they're called, your consumer reports. We say credit reports, but they're actually called consumer reports. Now, you can go to myfico.com. For a long time, myfico.com was kind of like the only place that we could view our mortgage scores. Now, you can also view your mortgage scores on Equifax, Experian, and TransUnion, but there is an additional fee. Those scores that you see when you first log on are not the scores that a mortgage lender will be looking at, because when you log on to Experian, they give you your FICO 8. A mortgage lender is not going to be looking at our FICO 8. And we're going to be getting into that next, what scores lenders will be using. Now, you can also get access to your credit reports on annualcreditreport.com. Um, those reports do not have your credit scores, but you can get them there for free. Now, remember I said that with Equifax, Experian, and TransUnion, in order to see your FICO scores, there is a fee. On myfico.com, there is also a fee. It's either $24.99 or $39.99, but those prices are, they can change, depending on when you're watching this course. So, but there is a fee for each website. Now, I did find a website where you can get your mortgage scores. You can actually get all 28 of your FICO scores for free for 7 days. If you go to the link under the picture of me, www.thecreditlaboratory.com/28, you can get access to all 28 of your FICO scores for free. Free, you guys. Free. Free, 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 free. And I'm going to also link that down in the below the video, so that you can just click on it and you can get those 7 FICOs, your 28 FICO scores, you guys, absolutely free for 7 days. 7 days. Can't beat that. But you do have to go through that link. But those are we will be needing our mortgage scores. Now, why is getting a copy of your reports important, and why should it be done first? It is important because if we do not have our reports, we do not know what is reporting. We're going to need to access all 3 of our consumer reports at least to see what's reporting on them and what our scores are. If we don't have access to those reports, we're not going to be able to know what's on them and do what we need to do in order to get that clear to close, in order to get our credit to the closing table. So, first step is getting a copy of our consumer credit reports. You need to, if possible, you can get your FICO scores, your mortgage scores, and you can get that from that link. Don't forget. Okay? If you already know what your scores are and you have an idea of your approval odds, if your scores are on the lower end, you'll know that, hey, I need to do some work. Or if you pull your reports and you see you have a few derogatory items, you'll know that, hey, maybe I need to try to take care of a couple of these before I, go to a lender. Because, guys, there are programs out that say that, credit scores don't matter. They can get you approved with a 580, but make sure you're seeing what your interest rate is going to be, because remember, the poorer your score, the higher your interest rate is going to be, because the lender is actually taking a chance on you. I'm not saying that what's going to happen with all loans, because I'm not a I'm not a mortgage loan officer. I don't know, but just look at those interest rates, you guys. Look at your interest rates, especially if you're trying to go in with lower credit scores. And remember, when your credit scores are lower, you guys, everything else is going to be higher. Your private mortgage insurance, your home insurance. You guys, your car insurance is even higher when you have lower credit scores. Okay, so your credit scores are important. We want to try to, focus, and not just our scores, because it's our entire profile, because our profile is what determines our scores. So our profile is just as important. Yes, we need to help get negative items removed and remove derogatory marks, but you guys, we also have to focus on building credit as well, because that is a part of the process. That's the most important part of the process, if you ask me, because you can get items deleted from your credit reports all day long. But if you're not building credit, guess what? Your scores they're going to bottom out somewhere. They're going to top out. It's going to only be so high they can go. So building credit is just as important, you guys. Now, when you're getting ready to purchase a home, say you figure out what your scores are, you have pretty decent scores, it is okay to go to more than one lender. It is okay to get multiple inquiries when you are applying for a mortgage. Whenever you are applying for a mortgage, an auto loan, or student loans, all of the inquiries that you get within a 30-day time frame, and sometimes it's a 15-day time frame, depending on which credit scores that are being used, or which credit y'all, I just lost track of my words, but it depends on which, because remember, we have different credit, we got 28 different credit scores. So whenever it just depends on which model is being used, because some models calculate things differently. So it could be 15 days or 30 days. I normally just say within a 30-day time frame. So all inquiries within a 30-day time frame, when you are applying for a car, a home, or student loans, they will report on your credit reports, but they are only calculated as one inquiry when it comes to your credit scores, because the credit bureaus think that it is okay for you to shop around to look for a better interest rate. They actually say that it is smart, and they encourage that. So they will not penalize you, by you shopping around looking for a better interest rate. So any inquiries done within a 30-day time frame will be calculated as one when it comes to your credit score. So it is okay to go to 2 or 3 different lenders if you want to see if they can offer you, a better rates and just different things that's better for your situation. It's going to be okay. Those inquiries won't hurt you as bad. And also, because I know a lot of people ask me this, if you go to that website, say that you go to that website and you pull out 28 of your scores for free, that will not put a hard inquiry on your credit reports. Whenever you're pulling your credit yourself on one of the credit monitoring sites, like that one, or Credit Karma, Credit Sesame, with your bank, most of the time, if you're doing it yourself just to view your reports, it's not going to be a hard inquiry, a little bit of soft inquiry. So you can go ahead and you can pull your reports yourself from as many different sites, as you like. That's not going to affect you. You only get a hard inquiry when you go to a lender and you're trying to get approved for credit with them, and they pull your credit reports. Okay, I've been talking a lot about what's scores are used in the 28 different credit scores. Okay, now it's time to break it down some for us. I know a lot of people, they'll go to the car lot because they've checked Credit Karma, and Credit Karma may say they have a 680 credit score. And then they'll go to the car lot to try to get approved for a car. And it's like they tell them they have a 560, so they're denied. And they're like, no, Credit Karma said I got a 680. The thing is, all of those different credit monitoring sites that I listed before, they may use different credit models, and you determine which credit model they're using, because when you look at your scores, even on Credit Karma, you can log into Credit Karma right now, look at your score, and if you log into Credit Karma, up under your score it's going to say Vantage 3.0. Vantage 3.0. That is because they are using your Vantage scores, and they're using the 3.0 model. They're using the Vantage 3.0. The last time I read up on it, Vantage scores were at 4.0. It's a Vantage 1.0, Vantage 2.0, Vantage 3.0, and a Vantage 4.0. And they're just calculated differently. And I said the mortgage lenders look at different scores. They're looking at our FICO scores. Remember, we actually got more than 28 FICO scores. We have over 30 different FICO scores, plus the Vantage scores. Those are the two different credit models that we have. We have the Vantage scoring model, and we have our FICO scoring models. And remember, the Vantage scoring model, the last time I read up on it, it had those four different models. FICO has over 28. FICO has 30 or more with our FICO scores. And they're going all the way back. And I'm going to show you, that's actually on the next screen. We'll be able to see all of the different FICO scores, and you'll be able to understand it better. But there's different FICO scores for different industries, such as there's FICO scores for the banking industry, FICO scores for the auto industry, FICO scores for your mortgage. Then they just have regular FICO 8, FICO 9, FICO 10, FICO 10T. They just have a lot of different models when it comes to your FICO scores. So when you're getting ready to go to a lender, those scores that we're seeing on Credit Karma, Credit Sesame, Credit Wise, over on Capital One with the credit, those are not going to be the scores that lenders are going to be using. Whenever you look at those scores, always remember to look underneath that score, and see which model is being used. And whenever you do that, you make sure you think of me too now. Don't forget about me. Okay, you guys. And those scores that we're seeing on Credit Karma and Credit Wise, they should actually just be used for educational purposes only, because a majority of lenders are going to be using FICO scores. Vantage scores were actually created by Equifax, Experian, and TransUnion as a way to compete with the FICO scores. Now, I hear them say it all the time that some lenders are going to move over and start using the Vantage scoring system, but I don't know. But as of now, most lenders are using our FICO scores, and Vantage scores are for educational purposes, because they were basically created as a way to compete with FICO scores. FICO scores were created first. And Equifax was actually the first credit bureau or credit consumer company to get access to those FICO scores. And they had to get permission from Fair Isaac them. And I can't remember the other name, so I don't want to get too deep into that. But that is that. We have those two different FICO models, different models for our credit scores. We have that Vantage and we have that FICO. You have that Vantage and that FICO. And these are the FICO scores that I was telling you about. You see here, we have widely used versions. And you guys, I got this graph, this model here off of myfico.com. Okay. You see, we have the FICO 9, the FICO 8. Then you see you have different auto lending scores. Auto 9, Auto 8, Auto 2, Auto 5, Auto 4. I mean, it's just a lot of different ones, okay? Now, then look at your credit cards. They got bank card score 9, bank card score 8, bank card score 2, FICO 3. I mean, just look at all of them. And then we get on down to the bottom. We see the versions of our mortgage lending. Those are the scores that lenders or our mortgage loan officers are going to be using, our lenders. Score 2, your FICO 2, your FICO 4, and your FICO 5. And those are each going to be, one of them is Equifax, one of them is Experian, and one of them is TransUnion. So they're going to be looking at your FICO 2, your FICO 4, your FICO 5. And then you see we also have other newly released versions. The Score 10, the Auto Score 10, Bank Card 10, FICO Score 10T. They just have a lot of different ones. Okay, so our mortgage lender is going to be looking at our FICO 2, 4, and 5. Now, when they're looking at these scores, say your FICO 2 is a 600, and say your FICO 5 is a 620, and your FICO 4 is a 630. We got a 630, a 620, and a 600. When the lender gets ready to go in, they're going to use our middle score. They're not going to use that highest score at a 630, and they're not going to use our lowest score that sits at a 600. Using the lowest score would be at a disadvantage, to us, and using the highest score would actually be at a disadvantage to the lender. So they use the middle score. Our middle credit score is used when the lender pulls all three of our reports. He sees which score is in the middle. But they will be our FICO 2, 4, and 5 mortgage scores, our mortgage scores. And remember, you can access those for free at www.thecrediట్లాboratory.com/28. And I will put that link in the bottom for you. And you get them free for 7 days. Okay, you guys, now we're getting ready to get to the good stuff. We're going to be discussing every negative item and every different account that could stop you or hinder you from getting approved for a home loan because of your credit. We're going to talk about how to get your credit scores up. I'm not going to tell you the best score, what score is needed, because I'm going to let you determine that. Because yes, you can. Remember, you can get approved with a 580, and if that's what you need to do at that time, we're all adults. That can be done, because say if you do get approved with a 580 score, you can go and work on your credit and try to get refinanced later to get better rates. But you're going to have to be determined to do that. You can't just say you're going to do that and don't do it, because you will be paying more in interest. So I'm not going to go into the different scores, because some lenders say a 600, some lenders say a 620, some lenders say a 640. I'm going to tell you how to get the maximum credit score in the least amount of time. And I'm going to tell everything we're going to be going through here today will be things that you can do on your own. Yes, you guys, on your own. Yes, my name is Jennifer Campbell. I am the CEO of the Credit Laboratory, and we do assist people with their personal and their business credit, but you can also do it on your own. And if you're in the business and you wanted to do it on your own, watching this course, you've already started. That's the best part. But watching this course all the way to the end will help you get where you need to get. I'm giving this information to y'all, and I'm going to give y'all everything that I have today. Okay. I may have to take 2-3 minute breaks to get me a little sip of water because I'm going to go nonstop. I'm not, I don't want to take like long breaks, but yes, I want to get through all of this information with y'all. But if y'all do want professional help because, you understand the process, you just don't have the time to do it, we're here. We actually have a home for the holidays. We have a home buyers program. We started this year because remember, I told y'all our goal is to help 100 families get into homes this year. 100 families who may be having credit challenges, or, they just don't know what to do and they need help building their credit profile. They need help or assistance getting or handling negative information on their reports. That's what their program is for. It's a 12-month program. The prices change monthly. It increases monthly because the name of the program is Home for the Holidays. So it'll be harder and harder to get someone in a home the closer and closer it gets to the end of the year. So each month the prices will increase. But if you are looking for professional help, we do have that 12-month program available where we will help you with your credit and hold your hand through the process, before, during, and after, when it comes to your credit. Yes. Okay. Today we're going to be talking about personal information, how that affects you, especially when getting a mortgage. We're going to be talking about applying for credit. Does applying for new credit hurt you? How does applying for a home affect you? We kind of touched on that earlier. We're going to go, we're going to hit on it a little bit again. keep all accounts current. We're going to be talking about the importance of keeping all of accounts current, the importance of building your credit profile and making sure you keep positive payment experiences showing each month on your credit scores. That's what we want. We want positive payments coming in every month. So we're going to be needing to keep our accounts current. We're going to talk about the effect of opening and closing new accounts. We're going to talk about payment history, credit card balances, because that's going to be one of the quickest ways to lower or increase your credit scores, you guys. And you may not believe me. I used to not believe it when I read it. I didn't believe it until I paid my credit card balances down and my credit score shot up 100 points. So I'm telling you, credit card balances. And we're going to discuss it more in detail. We're also going to be talking about collections and charge-offs. Do they hurt you? How to remove them? Will they stop you from getting a home? We're going to be talking about student loans, how it affects your debt to income ratio. We're going to be discussing how defaulted loans may cause you to be denied for a home loan, depending on the type of home loan you are applying for and the type of student loan that is actually in default. We're also going to be talking about evictions. Can they stop you from getting a home loan? We're going to talk about liens and judgments, bankruptcy, child support. We're going to be talking about all of these things in great detail, you guys, in very, very great detail. With liens and judgments, we're going to be talking about where they're found, how they're found. We're going to be talking about the bankruptcy process. Can you get approved in bankruptcy? How long does it take for you to get approved for a home after you come out of bankruptcy? Is bankruptcy actually right for you? We're also going to be talking about child support. How can child support hurt you? Can child support stop you from getting a home? We're going to be discussing all of that. Okay, you guys? Okay. I hope you are ready. Okay. First things first. When you pull your credit reports, you need to review everything from the beginning to the end. As the old folks say, from the rooter to the tutor. You need to review everything, starting with your name, starting with those inquiries, the public information, all of the accounts, everything. Review your entire credit report, because we're going to be looking for errors with everything, starting from our personal information, you guys. When I was getting approved for my home, I had to prepare a document. On that document, I had to provide an explanation for negative information that was reporting on my credit reports. And can you believe personal information was in there? Having too many names, too many addresses, too many phone numbers, too many employers on your credit report makes you look a little irresponsible. Think about it. A lot of employers mean you hop around from job to job. You can't keep a job. A lot of addresses, you move from here to there. You can't stay in one spot. Too many phone numbers. Oh, you gotta change and have a number. Too many names. Why so many names on the credit report? So we're gonna be starting with that personal information, you guys. We need one name reporting. Only one name. Preferably your first name, your middle name, your last name. You need that same name going across all bureaus. You guys, we only need one address reporting. One address. I had multiple addresses reporting. I had to explain, why I lived there that amount of time. Why did I move? Where did I move to? Like, it was just a lot. So go ahead and just get that cleaned off of there. And you won't have to, we won't have to explain it. One address. And it needs to be in the exact format, all the way across on all bureaus. From the address to the city to the state to the zip code. Everything needs to be the same. One address. You guys, we really don't need any employers on our credit reports. We don't need any phone numbers on our credit reports. And make sure you check your social security number and your date of birth, because you would not imagine how many times I go through a credit report. Social security number is one digit off. Date of birth is wrong because the year is wrong. You need to make sure that information is correct as well. So remember, we're going to pull our credit reports. We're starting at the personal information. We're starting at the top with the personal information. We only need one name, one address, no employers, no phone numbers. Make sure your date of birth and your social security number is correct. And you guys, I will put a free cleanup letter that you can access down underneath the video where you can clean up that personal information. Get that personal information cleaned up. We do not need all of that different information on there. After we get that personal information cleaned up, applying for credit. Okay, this is where it's going to get a little tricky, especially if you need to be building credit. It's going to get a little tricky because I'm now going to tell you to stop applying for credit. I'm going to tell you stop opening a new account. When you're getting ready to get approved for a home loan, you don't want to have too many new accounts open unless you're actually trying to build credit. And then if that's the case, you're going to have to let those accounts get seasoned some before you actually apply for a home, because most lenders want to see at least 2 years, of good credit age reporting. So stop applying for things. Do you know every time you open and close a new account, it affects your credit age? Our credit age is 10% of our credit scores, which calculates to around 55 total points. Because, our credit scores go from 300 to 850. So we have those 550 points. 10% of that 550 is 55 points for, inquiries and credit age. So every time you open and close an account, it shortens your credit age, especially if you don't have that much credit age built, and that affects your scores. Also, opening a lot of new credit can make you look risky, like you're, in a tight for money. So you also want to be careful about opening a lot of new accounts unless you need to be building credit. So be careful when applying for new things. Next, we're going to need to keep all accounts current. All accounts are going to need to be current. You want to continue to pay all your bills on time. When you're getting ready to purchase a home, sometimes you guys, a lender may not want to see late payments for the last 12 to 24 months. If you had a late payment a couple of months ago, what makes it that you're ready now? Just 2 months later, you're stable, already. So sometimes a lender they won't want to see a late payment. Now, I'm not saying that will disqualify you, because my lender can kind of help people in that situation, depending on their situation. But we want to keep all accounts current. Try not to have late payments within the last 12 months, you guys. If you do have late payments within the last 12 months, make sure you were actually 30 days or more late from your due date. Also, if you were late, you can try to get a goodwill from your creditor, but don't call them over the phone, you guys, because that's never going to work. You need to write them a letter, write a letter to the CEO, shoot them an email, or do both of those. And ask for a goodwill. Tell them your situation. Let them know that you're trying to purchase a home and those late payments are, kind of affecting you. Let them know that, hey, you have went through a little credit counseling. You've been educating yourself. Now you understand the importance, and let them know how you won't be doing it again and how much you would appreciate it if they could, do that small, kind gesture for you and your family to help you get into your dream home. How much you would just thank them for that. So you want to write a goodwill letter filled, with basically emotions from the heart and truth. If you're going to write a goodwill letter, and send that by mail or email. If you're going to email it, I still say mail it. So just do both if you want to. Email and mail to the CEO of that company. And you guys, if you have more than 3 late payments, sometimes it's not, they won't grant you a goodwill, because it's like you're a habitual offender. You kind of keep doing it and doing it and doing it. So why are they going to forgive you? So sometimes if you have more than 3, late payments, you can ask for a goodwill, because anything is possible, but sometimes they won't give it to you. You'll need to look for errors reporting, on your credit reports, and to make sure that you were actually, those 30 days late. So we want to keep all accounts current. Keeping all accounts current, you guys, also is going to be helping us build up positive credit as well. It's going to be helping us get more positive payment experiences showing, because remember, lenders are going to want to see at least 2 years of payment history. They want to see, multiple different accounts as well, but we're going to get into that. But they're going to want to see multiple different accounts, you guys. You can't just have one or two accounts open. Did you know if you just got 3 or less accounts reporting on your credit report, your file is considered thin? You need at least 5 accounts open, I say. At least 3 credit cards and 2 loans. Then you need different types of credit cards, because you have bank credit cards. Those are going to be our Visa, MasterCard, Discover, American Express. Then we have our gas credit cards, Shell, Raceway, Chevron, etc. Then we have our store credit cards, JCPenney, Victoria's Secret, Bell, Bath and Body Works, Aristotle, etc. So different credit cards. And then with your loans, you're going to need short-term loan and long-term loan showing. And that needs to happen because the lender needs to know that you're actually responsible and that you can actually handle different types of accounts. So yes, we're going to need to keep all accounts current. We're going to need to be building credit and getting our credit profile seasoned for the closing table, you guys. So keeping all accounts current as well. Opening and closing new accounts. Opening and closing new accounts. Remember, that can affect your credit age. And remember, I say here with one exception. If you don't currently have credit or you need to be building credit, you need to have at least 5 accounts open. And you see that formula I just mentioned? There it goes again, you guys. 3 credit cards and 2 loans. If you're just starting out, you have to be, you have to open up those accounts. That is fine and well. But also know you'll probably, or you may have to, wait until their season unless you have some other accounts on there. But if you're just starting to build credit, a lender wants to see 2 years of payment history. There are other ways to get 2 years of payment history as well. But sometimes some lenders, because I was going to say you can get authorized user accounts. On my FICO's website, though, I've read it so much, it states on some of those, for some things, it says that authorized user accounts aren't calculated in there. And then I've also heard some loan mortgage lenders say that they omit authorized user information. I don't know how true it is. I've heard some lenders say that they've gotten people approved with authorized user accounts, so I can't say. But if your mom has some good credit on one of those good old credit cards, like my grandmother had that JCPenney card since them early 80s, hey, get them to add you to that card. You'll get all the history, all the age, and it'll help with your credit utilization. So if that card been open 20 years, guess what? You'll have 20 years worth of payment history. So that is always good. But we want to be careful with opening and closing those accounts because of our credit age, unless we need to build credit. And if you don't know, you guys, and you need help with this, we also have consultations available. That link will be up under the video as well. We can, get a better understanding of your unique situation, because you may not know, your credit situation may be different. And we'll be able to go through your reports and let you know that. But you guys, we will need access to your reports too, because just like you need them to understand what's on your credit scores and to get your credit scores, ready for that closing table, we'll need to see them as well. Because if we can't see your reports, we won't know what's going on. And the information that we give you, will really not be valid for anything. I don't think so. All right. We're not going to be opening and closing accounts. We're going to be paying all of our accounts on time, but we remember the lender needs at least 2 years of payment history. 2 years of payment history. They want to see 2 years of payment age, you guys. So make sure we're getting some age on our accounts. You guys, I'm glad this. I'm actually glad this popped back up, because it brought it back to my mind to let you know, you guys, you can also get your rent reported. There are different websites that goes back and let you report your rent for 2 years. I think I heard someone mention before, like even longer than 2 years, but I'm not sure about that. Now, don't quote me on that one. I've only seen the websites where you can go back and you can get your rent reported, for up to 2 years, get credit for your rent, and I'll put that link down there as well, if you would like to check it out, because you can get those 2 years of payment history. And those accounts, you guys, like Afterpay, Klarna, all of that, where they're reporting for 4 months and stuff on your credit reports. You guys, that is not, those accounts are not good for credit, your credit profile, because it kills your credit age. It kills your credit age. When your credit age is calculated, it takes the average of your credit age. What if your credit age, your average credit age before you open up an account with Klarna or Afterpay or something was 5 years? Say it was 60 months. And then you open up a Klarna then for 4 months. Okay, they're going to take the average of those 5 years and those 4 months. Let's see. I'm fixing to tell you what that'll be. That'll bring you all the way down to less than 3 years of payment history. It'll bring you all the way down to less than 3 years of payment, not payment history, I'm sorry, or payment age. It'll be messing with your credit age, you guys. So be careful with those accounts. Be careful with those accounts. And just in case it's not in here, while I'm thinking about it, also when it comes to applying, like I said earlier, opening and closing accounts, after you've been pre-approved, that does not mean you're approved. Wait till you go to the closing table, you get your wet signature on those docs, and you get your keys before you go to Ashley's or Rooms to Go or whatever fancies you, Badcock, to get your furniture. Wait till after the closing table. Wait till after the closing table before you get your car, you guys, because any changes that's made to your credit profile after you're pre-approved, or any negative changes can affect you. Any negative changes are made to your credit report after you're pre-approved can hinder your chances of getting approved. And I said negative things because while I was going through my home process, I was still working on my credit. My credit scores increased, but they did not use my new credit scores. He told me they would be using my old ones. So that's why I say any negative changes, because I know people who have went and got a car before closing and they messed with their debt to income ratio, so therefore they couldn't get their home. And but sleep, it's choices and decisions, we have to make. But they probably did not know. So that's why we're doing this course, to educate you, So remember, you're not approved until you're approved. Pre-approval is good, but it's not set in stone until that document is on that, until your signature is on that document, your wet signature. Blow it a little bit and let it be dry. Then go and apply for whatever you want to get. But get your home first. Even right now, if you're thinking about, do I need a home, or, saying you need a car, but you're trying to get a home as well, that's going to affect your debt to income ratio. That's going to affect how much of a home you can actually get approved for. And if you got other things on your credit report, other debts and stuff, you don't want to do that, because you may not be able to get approved for as much as a home that you would like, because your debt and your income is going to affect that and control that, you guys. So Yes. We want good payment history, good credit age. We want good positive payment experiences, and we want to get our credit profile seasoned. Okay, now let's talk about credit cards and credit card balances. Remember, our scores go from that 300 to 850. Well, having a credit card, and the way we'll handle our credit card is 30% of that. Of those 550 points. 30% of that. And 30% of 550 points is 165 points. That's 165 points. It's controlled by having a credit card. You got to have one. And how you handle that credit card. Is it maxed out? Is it halfway maxed out? Are you being responsible with the card? That's what that controls, that 30% there. And I want to give this to you too. Say if you don't have a credit card, but everything else, I'm just going to say you're perfect everywhere. You got 10 or more credit age on there. You've never had a late payment, no collections, no charge-offs, no inquiries in the last year. We're going to say your little credit profile is perfect. Okay. But you don't have a credit card. Your credit profile is perfect, but you don't have a credit card. Remember, having a credit card is 30%. The way we having a credit card and how we handle it is 30% of our score. That's 165 points. And remember, we only get 550 from 300 to 850. Say if you don't have a credit card, and this matters too, even say if you don't have a credit card, or if you do have a credit card, but your credit cards are maxed out. but everything else perfect. You pay your bills on time, everything else is perfect. If you don't have a credit card or your credit card balances are maxed out, your credit scores can never go over a 685, and everything else can be perfect. You can never go over 685. So you can never make it to the 700 club if you do not have a credit card or if your credit card balances are maxed out. And it's actually if your credit card balances are reporting over 30%, and that's just a safety net. It's really under 10%. You need to keep your credit card balances under 10%. MyFICO.com states that high FICO score achievers with credit scores of a 780 or higher have their credit card utilization between 6 and 7%. So credit card balances are very important. Your credit card utilization is very important. Even if you have some loan accounts, it's okay to go ahead and pay those down, especially if they're open lines of credit, because open lines of credit will be, affected in your credit utilization. So make sure we're keeping our credit card balances low. Having our credit card balances maxed out affects our debt to income ratio, and also makes us look like we're in a tight for money, that we didn't have the cash, so we had to charge it, and we don't have the money on the card, especially if it continues to carry a balance. We don't have the money to pay the cards, so we want to make sure when our credit cards are reporting, when they're reporting to the credit bureaus, we need to make sure they're reporting less than 10% of our credit limit. And you guys, most of the time, your credit cards are going to be reported 3 to 7 days after your statement end date. 3 to 7 days after your statement end date or your statement closing date. We have 3 different dates on our credit card statements. We have our due date, which we would need to make sure we always make our payments by our due date. And then we have our open statement date, and then we have our closing statement date. So there's 3 different dates. And whatever your balance is on your statement ending or statement closing date is going to be the balance that's reported to the credit bureaus. And we always want that balance to be 10% less than our credit score. Not our credit score, I'm sorry. 10% less of our credit limit. If our credit limit is $500, we don't want more than $50 to report to the credit bureaus. And say our statement end date is on the 23rd, we want to go ahead and make sure our balance is under 10% by the 21st, by today. And if our statement end date is on the 23rd, around 26, 27, 28, 29, 30th, it's going to be reported to the credit bureaus. And what's going to be reported is whatever your balance was on the 23rd. Okay? That's credit cards, you guys. You need to stop, rewind, catch that again. Okay, remember that those are very, very important. They affect our credit scores and our debt to income ratio. So, we want to get our credit cards and stuff paid down as much as possible. Now, collections and charge-offs. Can collections and charge-offs stop you from getting approved for a home? Yes, they can. Can you get approved with the collection or charge-off on your credit report? Yes, you can. Can you get approved with the collection and a charge-off reporting on your credit report with the balance? Yes, you can. It depends on the lender. It depends on your current debt to income ratio or the debt that you currently have. Is it your only one? How much is the balance? And, the lender, it depends. But yes. You can get approved with charge-offs and collections on your credit report, whether they have a balance or not. But do we want to do that? We want to work on getting as much negative information removed from our credit reports as possible, because it makes our profile look better and it helps our scores as well as our debt to income ratio if that account carries a balance. We want to make sure we can at least get that account to a $0 balance. And it's okay to pay charge-offs, not debt collectors. It's okay to pay charge-offs that are still with the original creditor, and it's still reported on your credit report and it shows a $0 balance. That's actually correct. They do not have to remove the account. The creditors and the credit bureaus do not have to remove accurate information or verifiable information from your credit reports, you guys. Okay? So if the account was charged off and you made a settlement, that's fine for it to report on there, as long as that balance is reporting with a $0 balance. It looks better to have a $0 balance than to look like you still owe that creditor $2,500. Okay, a lender can let you get approved with a charge off with a $0 balance. I know I had them, but I had a repo on my credit reports from Capital One. That repo had to be taken care of for multiple reasons. For one, it was $13,000 and it was hurting my debt to income ratio. For that balance was just too high and it needed to be taken care of. I was able to make a settlement for $1,300, give the lender that letter, and keep it moving. But when it reported on my credit report, it reported a $0 balance because, like the lender told me, he just needed to say zero. It doesn't have to go away, but it does need to say zero because at least he can look at it and say, well, life happens. We don't know what happened, but at least she took care of it. So paying charge-offs is okay. Debt collector, it's never okay to pay a debt collector first. You always need to ask a debt collector for validation before you pay them any money. You will never believe how many people come to me and say they paid the same collection to two different companies or the same collection twice. It's just ridiculous. You need to make sure that the debt collector, because debt collectors are savages. They're savages. Think about it. They go and pick up what the debt collector doesn't want. They're savages. Okay? So you need to make sure that they actually have ownership of that account and they can actually collect on that account in your state as well. You need to make sure that they have proof that account belongs to you. They need to validate that account. They have to validate it. And when you're asking for validation, you're going to be needing to do that directly with the debt collector, not with the credit bureaus. You can still challenge the account with the credit bureaus, but when you're challenging accounts with the credit bureaus, you need to be challenging them for verification or for, different errors that may be reporting. It's different with debt collectors because validation, that's a debt collector law. That's the FDCPA, and that is for debt collectors only. It does not apply to the credit bureaus. So you'll be asking the creditor, the creditor, the debt collector directly to validate that they own that debt, they have ownership of that debt, that debt belongs to you. They can't validate it, they need to stop making collection activities on that debt, and they need to take it off of your credit report. Okay? But handling charge-offs and collections, getting them removed, paying them, handling them, whatever, it is okay. Now, a lot of debt collectors offer pay for deletes. If that debt is yours and you know it's yours and you can get a settlement and they'll delete it from your credit report, go for it. Go ahead and do that, especially if you only have one or two, okay? But don't just pay them, before you ask for validation and, you get proof. And your original creditor actually is supposed to send you a letter that states that they sold your accounts to such and such. On your credit reports, the original creditor is actually supposed to be reporting who they sold that debt to, okay? And they're not doing that. The original creditor is not doing that. And most of the time, the debt collector is not listing on your credit report who they purchased the debt from. So they need to validate all of that. There are laws to protect us, you guys. Those laws are not in place to protect the debt collectors. Those laws are in place to protect us, and we need to use them, okay? So charge-offs and collections, yes, you can get approved if they have a balance or if they don't have a balance, but we want to get them taken care of. If they're with the original creditor, most of the time, original creditor will not offer you a pay for delete because they are the original creditor. They have everything that they need to prove that you actually own that debt or that debt belongs to you. So they will do a settlement for you, and that is perfectly fine as long as that account has a $0 balance, you guys. That is charge-offs and collections. Student loans. Let's talk about student loans, you guys. Okay. With your student loans, we have different types of student loans. We have private student loans and we have federal student loans. Private student loans, we're going to handle those just like we handle charge-offs and collections, depending on who they're with, if they sold it to a debt collector or not. Because a private student loan is with a private lender. Now, our federal student loans, babes, they're different. They don't go away. And they have to be handled differently. They have to be handled with care, if I may say. Those federal student loans do not go away. If you have federal student loans in default, you will not be able to get more assistance with student loan help for college And you also will not be able to get approved for any type of federal funding. Any type of federal funding, as long as you have federal student loans in default. So we want to make sure we keep our student loans in some type of deferment or a payment plan. We have a lot of options available. If you go to studentloan.gov, you can see all of the different programs that are available. There are programs available to wipe away your debt. There are programs available to lower our monthly payment. There's programs available to defer your payments monthly. So there is no reason our student loans should be in default, but our federal student loans, because private student loan lenders do not have to offer the things that federal student loan offers. Federal student loan lenders offer. Because if you have federal student loans in default, remember I said they don't go away, and they are found on our CAVRS report. Even if you get them removed from your credit reports, if they are in default, your lender is going to find them. They are going to find them, okay? They are going to find them. So if we got federal student loans in default, that means that we owe a balance on them. We haven't been paying on them, and, they're in collection status, charge-off status. We have 2 to 3 options. First option, pay them off. Second option, consolidate them. If you consolidate your student loans, it will not remove the mark of default, but it will get them out of default. But your credit reports, those old accounts will still report as defaulted, but it can get them out of default. And that's what you would need. And that's one of the quickest ways to get them out of default besides paying. The third way is going to be rehabilitation. Rehabilitation, and like I said, federal student loan offers this. Private student loan lenders do not have to offer this, and they don't. So rehabilitation, if you have defaulted student loans, you need to contact your student loan servicer provider. Talk to them about rehabilitation. And that's if you don't want to do consolidation. Like I said, consolidation is the fastest way, but that remark of default will remain on your credit reports. If you do rehabilitation, that is a 9-month program where your income will be used to determine your monthly payments. All of those payments have to be made. Most of the time, those payments are anywhere from $0, $5 to $20 per month. The highest I've actually seen with a client is actually $5 per month when they get them into rehabilitation. After you complete those 9 months, your student loans come out of default. The remark of default is removed, and you can go back to getting federal funding. So, that's your key to go back and get your federal funding. Even, with SBA loans, if you have a BITS or anything, if you have student loans that are in default, you can't get access to any of that. But if you consolidate your student loans or go through rehabilitation, you can get, you'll be able to qualify for those things again. With rehabilitation, you guys, you can only do it one time per loan lifetime. So be careful with that. And when you consolidate as well, think about it. If you consolidate all of your student loans, if you get them in default, you can't consolidate them again. I normally tell my clients to try to leave 1 or 2 loans out or consolidate 2 separate groups. Just in case something happens, you'll have some, accounts to consolidate again, because I don't care what you say, you guys, life happens. Life happens. I messed up my credit, I'll say 3 times. Life happens. Life happens. And we just need to know how to maneuver through it when it happens. Evictions. Okay, you guys. If an eviction is showing on your credit report, what do you think a lender is going to think? If you can't pay your rent, you most definitely can't pay your mortgage, or you won't pay your mortgage because you didn't pay your rent. So we have evictions reporting on our credit reports. We're going to want to try to get those removed. We want to try to get those removed. If we can't get them removed, we want to try to make a settlement, you guys. We want to try to make a settlement. And remember, evictions are public records, so they can be found. Evictions are public records, so they can be found. Public records. All public records can be found on Pacer. Anybody can get a Pacer account. I have a Pacer account as well, but anybody can get a Pacer account. Pacer.gov. So if you have evictions reporting, make sure you can get them removed from your credit reports, or you try to make a payment arrangement with them to get them removed. You guys don't forget, we do offer those We have consultations if you need help, and we also offer professional services to help you through the process. Don't forget about our 12-month program. Liens and judgments. Liens and judgments are public records. You have liens and judgments reporting on your credit report. Well, they won't be reporting on your credit report, but they'll be found. They'll be found during the titling process. When I got ready to purchase my home, I didn't even know I had a lien. I had a lien with the state of Alabama. They said I owed state income taxes. I had to pay that before I could get a home. It wasn't showing on my credit report. I didn't know anything about it. But during that process, guess what? They found it. And it's gonna be, and like they're looking for this, especially the title company and stuff, because if you owe somebody money, if you're in default with somebody, they can sue you and they can take you to court. And if they take you to court, that puts your property in jeopardy of a lien. And they don't want to lien on their property, so they try to make sure all of that is taken care of before you get your home. They want to make sure you don't have those lingering debts out there. So that's why they're looking at all of that stuff. So if you have liens and judgments with balances on them, those are going to need to be taken care of, you guys. We're going to have to get those taken care of. Next, let's talk about bankruptcy. You can get that bankruptcy removed from your credit reports as well, you guys. You can get it removed from your consumer reports, but guess what? It's still going to be found during the loan approval process because they're going to be looking at the PACER. Remember, those are public records. Bankruptcy is public records, you guys. Can a bankruptcy stop you from getting a home? Yes. Can you get approved with a bankruptcy? Yes. You can even get approved while you're in bankruptcy. Huh? What? Say what? Yes. You can actually get approved for a home while you are in bankruptcy, but you do have to be in a Chapter 13. You have to be in that Chapter 13. Some lenders say 9 months. Some lenders say 12 months. You cannot be in the midst of payment. You have to be in there making everything on time in a Chapter 13. After you have been in there and you've made your payments, you can get approved for a home. Now, if you wait till you get out of Chapter 13 to try to get approved for a home, you have to wait that allotted amount of time, depending on your paperwork and your bankruptcy and what the lender's laws are, what the lender's company says. Because some places say a year, some places say 2 years. That's normally what I hear people say. You have to wait 2 years after you come out of a Chapter 13 or a Chapter 7 bankruptcy. You have to wait that allotted amount of time. Now, there are some lenders, I know my lender can. There are some lenders that can get you approved for a home after you come out of a Chapter 7 and after you come out of Chapter 13, depending on extenuating circumstances that you may have. So, but normally, if you do a file for a Chapter 7, Chapter 13, after you come out of bankruptcy, you have to wait that allotted amount of time before you can purchase a home. If you are in Chapter 13, you can get approved for a home after you have made 12 of your bankruptcy payments on time. Those payments got to be on time, you guys. And you need to do it before you get out of bankruptcy, before you get out of Chapter 13. If you wait until you get out of Chapter 13 or until you finish Chapter 13, you will have to wait that allotted amount of time, those 2 years, before you can purchase. But you can get a home while you're in Chapter 13. That is some of the best news, huh? So that's a good thing. But remember, if you wait until after you finish that Chapter 13, you do have to wait that allotted amount of time before you can purchase. Child support. Can child support stop you from getting approved for a home? Sure can. Yes, it can. If you have child support in arrears, that can stop a lender from approving you. You guys, if you have child support in arrears, you want to try your best to get on some type of payment plan or to catch it up, but at least get on some type of payment plan. Because as long as those payments are in the arrears, you won't be able to get approved. So make sure you get those out. And those are also, sometimes I think child support, I don't know, but it needs to be out of arrears, you guys. The child support shows on your credit reports too. So, and you have to provide your check statements, our pay stubs, your pay stubs. And if child support is coming out, they'll see that on your, on your check stub, so you can't hide it. So if it's in the arrears, we want to get it out of the arrears, and at least try to make a payment arrangement. Now, you guys, we're fixing to be wrapping up here in a minute, but I want to go back over the importance of building credit building credit as well. Remember, all of these negative items do not need to be reported on your credit reports. They do need to be, removed, or much as them as possible, because you may not be able to get everything removed or handle all of the negative accounts. And that's okay. But you're going to need to focus on building credit as well. Make sure you have the appropriate amount of accounts open. Make sure you aren't getting any late payments. Make sure those credit card balances are paid down under 10%. If you have some charge-offs and collections with balances, you guys, you want to make sure you get those taken care of. But make sure we remember, building credit is just as important. Now, you guys, I got a bonus down here for you. You're going to need to start saving as much cash as possible. As much cash as possible. Not only just for, say, if you need to pay off collections or charge-offs. Not even because you may need it for your down payment. You may need it for earnest money. You may need it for closing costs or different things. Just keep saving, because even when you get in your home, if you've been renting, when you purchase your home, guess what? Guess who that new landlord is? That's going to be you. We need a savings account put up for a rainy day. Just in case that toilet messes up, or just in case something happens to that water heater or that central unit. We want to have us a nest egg set aside for our home, because now we are a new, proud landlord, So make sure you're always saving. Save for this debt. Save for the money that you're going to need for your down payment, and save for, things that may happen when you get in your home, or even for upgrades. Most importantly, you guys, I want you to know that you can do it. If little old me, with everything that I had going on my credit reports, got approved for a home, so can you. You guys, it took me 8 years to actually get approved for a home. The first time I tried to get approved for a home was back in 2012. I looked at a little small, modest home. It was nice and needed a little work, but it was just something, that I looked at. I got denied. No one told me why. No one said anything. The lender even showed me the home without a pre-approval. That's how you know it was a long time ago. And I was in a little small town back at home. But it actually took me like 8 years, because, to get approved after that. Because after they told me that, I just gave up. I didn't think about it again. I was just like, I just never have a house. I'll never be able to do this. I'll never be able to do that. And I let that mindset, and I let that sit in my spirit for all of those years, and it hindered me. And I'm going to tell you what I had on my credit reports to stop me. This is one of the reasons why I am pushing to help 100 families this year. I had 2 collections, no charge-offs. I had credit cards open and loans open. I didn't have any late payments. I had my student loans. My credit cards were maxed out. So, I was losing 165 points off the top. They were just gone. And not only did I have those 2 collections, I had a collection with Dish Network and one with AT&T. Both of them were like $200 and something or less. The little credit cards I had, the highest credit limit I had was $600. And I think I had a Capital one for $500 and then one for $200. Like 3 little credit cards, and those 2 negative accounts is what stopped me from getting a home for 8 years. I didn't know to just go pay my credit cards down to under 10% and call and make a settlement for those 2 accounts. I probably could have paid 50%. If those accounts were $200, I probably could have paid $100 on each one of those and got them removed from my credit report. No one took responsibility, not even me, to help me during the process. Not the real estate agent and not the lender that I went to. No one cared to tell me what to do. No one cared to help me. That is why the Credit Laboratory has started this 12-month program. That is what I want to do for people. Yeah, and that is why, because of my story and what I went through, and this Clear to Close credit came to me, and I think this is just the right road for us this year. But you guys, like I said, if little old me can do it, you most definitely can do it. If you can't do it by the end of this course right here, schedule a consultation with us, you guys, down at the bottom with that link, or come on over if you want some professional help, and let us do it for you, you guys. But now, we know now that you have all of the negative information written out that may hinder you, because when you're going through this process, you guys, you're going to be going through your credit reports. I want you to go ahead and get access to those FICO scores through my website for free. Go through all three of your reports. Remember, we're starting at the top with the names and we're going through everything. And we're going to be looking for all of that negative information we just talked about. We're going to be looking for that in our credit reports. I want you to highlight it, mark it, write it down, circle it or something. Take note of it so that you have it. Take note of it so that you have it. Because once you go through your credit reports, we want to handle everything that's hindering us. We want to get all of that negative information removed. Okay? Now that we have all of that negative information written out that may hinder us during the approval process, now it's time to go to work. Now it's time to start working on removing that negative information and handling any past due debts that we may have, you guys, any past due balances, even paying our credit utilization down. Remember, anything can be removed from our credit reports, but not everything may be removed from our credit reports. Even if a negative account is not removed from your credit reports, it's okay. Just make sure you take care of those past due balances, you guys. And finally, although getting negative information removed from our credit reports is important, do not forget we need to be building credit and keeping those credit card balances low. You guys, I want to thank you for joining me today. If y'all have questions about this course, please feel free to drop them down below. Don't forget to get your free credit reports and go through them, starting at the beginning with your name all the way through to the bottom. We're going to get that negative information removed. We're going to make sure we're building credit. We're going to do everything that we need to do. We're going to start saving money as well so that we can get access, so that we can get not just access, so that we can hear that you're clear to close. When you go to that lender, when they pull your credit, you want them to be able to go ahead and not just, you want to be pre-approved and pre-qualified. We want everything. Okay, you guys, again, thank you for joining me. If you have any questions, please feel free to drop them down below. And again, I hope you enjoyed this course and I hope that it can help you through the process. You guys, we also have a clear to close credit guide where you can get most of the same information and you have a guide where you can write it down. We give you a little bit more information in writing to tell you what you're looking for and kind of how to handle it. But that is available on Amazon and you know where the link will be. You guessed it right, down below underneath the video. You guys, again, thank you for joining me in the Credit Laboratory for our Clear to Close credit course. Have a good one.